Hello and welcome to the day ahead. It is Wednesday, June 1st. I'm Andrew Gagan. Well, Wall Street back online after the Memorial Day long weekend and ending sharply lower, snapping a three-day winning streak as volatility returned with a vengeance, with traders focused returning there to a runaway inflation and hawkish Fed speak. Energy was the hardest hit on news that OPEC Plus was considering excluding Russia from its production deal. And consumer discretionary, the only sector in the black, with Amazon the biggest boost to the S&P. For the month, the S&P and Dow both flat, while the Nasdaq fell just over 2%. And on bond markets, US Treasury yields touched one-week highs but posted its largest monthly decline since 2020, driven by softening economic reports during the month and indications that US inflation may have peaked. Well, the rate-sensitive two-year dropping more than 18 basis points in the month, its largest drop since March 2020, while the benchmark 10, that yield falling 9.3 basis points, the first monthly decline since November 2021. Well, major currencies were mixed against the US dollar. The Aussie easing to close from 72 US cents. It's currently at 71.9. Eurozone inflation. Well, that rose to yet another record high in May. Inflation accelerating to 8.1% for the month, above the 7.7% that was forecast, as price growth continued to broaden, showing that it's no longer just the cost of energy that's pushing prices higher. Headline inflation is now 4 times the ECB's 2% target, and that will embolden the policy hawks at the central bank to lift rates sooner rather than later. And rising inflation and interest rates eroding US consumer confidence in May as Americans become more cautious about spending. Consumer inflation expectations over the next 12 months dipped from 7.4% from 7.5% in April, which fits with the economists' views that inflation is likely to have peaked. And the Conference Board also showed consumers' perceptions of the labour market is softening, in a further sign the Fed's monetary policy tightening is slowing demand. Meanwhile, the Chicago PMI survey beat expectations, citing a large increase in inventories and increased concerns over supply constraints from China's lockdowns, while demand was described as extremely strong. And the US house price index rose 19% on the year to March. Well, the Australian share market is poised to edge lower this morning, with ASX Futures currently down 0.4%, or they're close to it. And global oil prices, they were boosted on the easing of COVID restrictions in China and on news that the European Union has agreed to cut 90% of oil from Russia by the end of the year. However, prices then eased on reports that OPEC Plus would suspend Russia's participation in the production deal, allowing other members to lift output. The Brent crude price there finishing at $122 a barrel. The iron ore futures price falling marginally to $133 a tonne, while base metal prices were mixed, with aluminium, nickel and copper falling by as much as 3.5%. And rising bond yields saw the gold futures price fall by 0.5% to $1,848 an ounce. Crypto markets resumed their rally overnight as Bitcoin regained the $31,000 level, with Cardano's ADA token leading gains among the majors, up some 17%. Well, looking to the day ahead on the data docket, it's all about growth figures. Forecasts are for GDP to come in up 0.5% in the March quarter, though it's expected to show a moderation in activity, with the annualised figure tipping to drop to just below 3%, largely due to damaging floods and COVID outbreaks. And that is your day ahead. See you again tomorrow.